Welcome back to the Money Under the Mattress podcast. My name is Mitch and my co-host is Jake. And today we are joined by Bryce Dooley. Bryce is the founder of DB Capital, where he mainly brings in younger investors. Bryce tied for second in last week's FinTwit Stock Pitch Challenge, where he pitched the company Motorpoint, which I'm sure we'll get into later on. We're excited to talk to him today about how he invests, DB Capital, as well as his write-up on Motorpoint. Thanks for coming on with us today, Bryce.
Thanks a lot for having me, guys. I'm looking forward to it. It's really nice to connect with some new people on FinTwit.
Yeah, it's we kind of recognized you from your Motorpoint write-up when we were listening to the Twitter Spaces FinTwit Stock Pitch Challenge. Like we followed Bill Brewster for a little while now, and then same with it, like a couple other guys, Elliot Turner and stuff. So it was nice to see a young guy in the challenge. So
I'm right there with you. I followed those guys for a few years now too. Really enjoy them. I kind of felt like I was out of place a little bit, but it was super cool to connect with all those people and discuss ideas. Good. It was really good networking opportunity.
Yeah, like did you get a lot of DMs afterwards? People trying to connect you?
I got a lot of new followers. I got some DMs. I got a lot of good feedback on Motorpoint from people that are smarter than me, that know more than me. So I can continue to build conviction, work on my thesis here, because so many people are so open about sharing stuff they've found, sharing their notes with me. So yeah, it was really cool to just have people reach out.
Interesting. That's awesome, man. So congratulations again. That's big accomplishment, especially I'm pretty sure I saw that even the audience, they voted you first place. Is that correct?
Yeah.
Yep. So that's quite the accomplishment, man. So congratulations.
Thank you.
I guess we'll start off on our first question. This is usually the first question we go off on is what is your backstory on how you started investing?
Not super conventional. Started in high school, getting interested in it. I'd say interest was first piqued, honestly, due to the movie The Wolf of Wall Street. As funny as that might be, I feel like that might be true for a lot of kids around our age. But my brother and one of my best friends, after we watched that movie, they were like, this Jordan Belfort guy, he made a ton of money on these pink sheets, and they're taking Steve Madden public in the movie. And we just got kind of interested in how the stock market works and how you can learn to profit in the market. And we knew absolutely nothing at that time, but we kind of decided to form our own little investment group, and we had a shoebox and said, we're going to try to throw as much extra money, spare change, every dime, every penny into this shoebox, see how much money we can come up with, and then we'll start learning about the stock market and try to invest this money and pick stocks. So I started with basic books like The Motley Fool's Investment Guide for Teens that talked a lot about compound interest. I'm pretty numbers oriented, so that fired me up a lot. Continued to just read anything I could get my hands on, went to Peter Lynch, found my way to the Warren Buffett way. And then when I was 18 or 19, I started reading all of Buffett's letters and just kind of kept going from there. I was just my interest never really faded. So I tried to get in as deep into it as I could. So then in college, I was a student athlete. In my free time, I did a lot of research and trying to learn. I always felt like I didn't have enough time to do that. But by my junior year, I had a little bit of a track record with my own money and just talking with my friends about what I was doing. And I had a couple friends come to me and said, hey, can you just do what you're doing for yourself with a little bit of my money, and we'll see how it goes. So that's kind of how it got started for me. Really, the Wolf of Wall Street reference, that's not really what motivates me, what you see in that movie nowadays, but it's definitely something that piqued my interest at first, to try to learn this stuff and see how it works. Now I just really enjoy the research process, understanding businesses, and trying to find really good ones.
Yeah. So have you always been a fundamental analysis investor? Like, have you always been doing fundamental analysis, or when you started, did you get sucked into like the day trading or anything like that?
So I've read the Ben Graham, and pretty much my foundation was formed by the Buffett letters. So I'd never have tried the technical analysis, never tried the day trading. I was definitely more active than I should have been when I was trying to get going and figure out how it all worked, thinking every idea I found was a good idea, even though it obviously never works like that. And still very inexperienced, young, tons to learn. So I'm probably still more active right now than I should be. But yeah, I've always stuck with fundamental approach, trying to be patient, making sure I understand the business, trying to identify if there are any competitive advantages, what those are, how those come into play. Are they weakening or strengthening? If those things are even identifiable. Sometimes I think it's really hard to even find anything. And just trying to stick within those few companies where I feel like I have a grasp on that. Because honestly, I only follow probably 20 companies where I actually feel like I might have an advantage in knowing something, or might be patient enough to wait for the right price to where I might have an edge against anyone else or the market.
So when talking about those companies, those 20 or so that are within your circle of competence, I guess you could say, what kind of businesses are you looking for when searching for an investment?
Well, it's pretty standard to hear it today, but kind of the quality growth at a reasonable price, which is probably the most expensive thing in the market today, which kind of sucks. But that's kind of what I've been drawn to as a sustainable way to just generate durable, solid returns. Companies like, I think Berkshire Hathaway qualifies. Sometimes they get thrown out a little bit as being boring or slow and not able to grow, but that's a company like Apple, American Tower, O'Reilly Auto Parts, KKR, CarMax, those type of companies that have, once you get to understand the businesses, I think there's identifiable competitive advantages, and they have great returns on capital. They've got room to grow as well, and good management teams that are doing the right things with the money. So yeah, that's kind of a handful of the ones that I do follow. And so far, I feel like I can add companies to that list every so often, but it seems like it gets harder and harder to just build conviction as I continue to gain experience. I keep falling back to my top 5 and saying, well, I know these better than anything else, so why should I even bother either looking at something that looks so or trying to spend time there when I can continue to just build conviction in my top 5 or top 10.
So it sounds like you took more of the Munger approach than the early Buffett approach. Have you ever done like deep value on any businesses, like a type of investment with deep value, or are you more of a growth investor, or are you just growth at a reasonable rate or
Well, I
reasonable
would
price?
say because I'm young and inexperienced, I've been working in the market with my own money for about 5 years and managing money for other people for 3 years. So I wouldn't say that I would want to define what I'm doing yet. Still feel like I'm trying to figure out what fits my temperament. But you're probably right that now I'm evolving more towards that Munger style. But in the past, as I mentioned before, I was a lot more active, looking for a lot more diverse type of ideas. I have done a few things in deep value where I'm looking at a $10 million market cap, and then there's $8 million of cash on the balance sheet, no debt. So there's a margin of safety and then some other catalyst that might realize some value. I've done that. It doesn't really suit me. I feel like you're kind of waiting around for something to happen that might not happen, where these great businesses are continuing to execute, grow market share, grow sales, repurchasing their stock, and you're getting an ever-growing portion of the business that way. So your rate of intrinsic value growth, it feels like it's always growing with these great businesses. That kind of turns me on to that a little bit once you feel like you have a grasp there. So I've done some of that deep value. I didn't have great results, and I had a hard time with the patience of it, just because it can be so obscure, and in some situations it feels like you're not really getting any wealthier, or your shares aren't really growing in value much.
Did you ever seek out any special situations? You ever like go into that side of things?
I think I did once. I tried doing something with a tender offer one time, and the tender was going to be a pretty solid gain above where the shares were trading, and they didn't end up doing it. And after that, I was kind of like, I would rather just focus on these really good companies than kind of mess around here, where you've got to continually turn over rocks to find these things. And some of the rocks, there's nothing there. Whereas once you find a great business, if you get it at the right price, as long as you've got your conviction, you can continue to add to that position, continue to learn about it, and go from there. And you can make a ton of money on just 5 names, in my opinion.
So have you read like the Nick Sleep letters? Are you familiar with that?
Yeah, I think a couple years ago I made my way through the whole thing, and then I just recently restarted those letters, and I got about halfway through. That's some of the best stuff.
Yeah.
That's what I kind of got me excited about your write-up on Motorpoint, when you kind of talked about how they were giving back some savings to the customers, because, Nick kind of coined that term, scale economy shared with Costco. So that's what really got me excited about
credit to him. That's definitely where the phrase came to my mind.
Yeah, I mean, the Motorpoint write-up, that was an excellent write-up. Because how old are you?
23.
I am 23.
So 23 for being 5 years in the market. That was an exceptional write-up.
Thank you.
And do you want to go a little further into detail on like just like a short thesis on your Motorpoint write-up, or what you feel intrinsic value-wise, or whatever it is you'd like to discuss?
Yep. I'll try not to get into it too much, but so they're one of the leading used car dealers in the UK, and they really take an approach of driving volumes at their stores, and these volumes allow them to offer lower prices to customers, and which kind of creates the flywheel effect that Costco has, where the customers are happy because there's good service, the prices can't be beat, so more customers come, which allows for even lower prices because you're leveraging a low fixed cost base. Motorpoint really tries to keep their overhead base low and just sell as many vehicles as they can out of their existing stores. I think that their existing business is really durable because they've got super high market shares in some of their existing markets. Some of those are up to 25 to 30%. And so there's online entrants that are coming in. They're trying to take a low pricing approach, which presents a risk for Motorpoint with their growth. But I really think Motorpoint has established processes, a trusted brand. They've got a net promoter score of 83, which compares really favorably to super popular brands like Amazon, Apple, Costco, and the average car dealership score is around 40. So net promoter score, that's just the likelihood of a customer to recommend. And 1/3 of their sales are to repeat customers. And that's probably a lot higher in their mature stores, because they have about half of their stores right now are pretty new, under 8 years old. So there's kind of a half and half with Motorpoint. They've got really dominant, mature, older stores that are operating at super high volumes with really established customer bases, but they've been opening stores. So about half of them are immature and still kind of ramping up. But overall, it's priced pretty fairly. I wouldn't say it's cheap because it's kind of rallied recently. They just announced a new growth strategy, and the market kind of took off with that. But it's really kind of fairly priced for what I think is a solid business, and there's kind of a lot of optionality growth wise because they're at 4% market share. Older sites are at 13 to 30% share, and they're planning to double their physical infrastructure in the next few years. So they really could grow that market share quite a bit. We'll just have to wait and see. I think there's a margin of safety with how dominant their existing sites are.
Yeah, like you also own CarMax too. Is that correct?
Yeah, so I got onto CarMax before I found Motorpoint, understood that business model. I understand it a lot more now than I did when I found it, but just continually learning with these businesses and trying to gain further understanding. But I kind of used the CarMax model as I was doing my research on Motorpoint, just using the same pieces that I learned from CarMax, comparing them to Motorpoint. And then as I got deeper and deeper, I kind of started to notice some differences. Like CarMax operates on a 10% used vehicle, retail vehicle gross margin, and Motorpoint's is like a third of that. So that made me start asking questions like, is Motorpoint not able to get the purchasing scale and get cost efficiencies on the purchasing side with vendors? Is that a disadvantage for Motorpoint? And at first I thought that's probably what it was, because CarMax is so big, they've got to have better purchasing from vendors than a company like Motorpoint would in the UK at a 10th of the size, or 5th of the, or 20th of the size, sorry. But as I looked further and further, I found that Motorpoint's got some pricing advantage, because 92% of people surveyed said their prices can't be beaten. And they even offer a price promise where if the customer can find a like-for-like vehicle at a lower price than Motorpoint offers, they'll completely refund the difference and give the customer a 50 pound in the UK Amazon voucher. So that right there, I was kind of like, well, if they're going to give a $50 gift card if a customer can find a cheaper car, that's like a fifth of the profit they even make on a car. So they're pretty confident they've got the lowest prices if they're going to put that offer out there. And only 1 in 1,000 customers even claim that offer. So I don't think it's that that Motorpoint doesn't have the purchasing power with vendors to give it the low prices. I think they're just deciding to keep the prices low and drive volumes. Whereas CarMax is probably more in a position, they're a lot more spread out around the country, have a lot more stores, probably a little more saturated. They can kind of still operate with a little higher prices. They still do good business, and they have excellent service and good customer trust, which I think allows them to do that.
Yeah, like the thing that, yeah, same with Jake. Like the thing that piqued my interest with the Motorpoint is when anybody compares a business to Costco, it's like an immediate like, all right, this is a green light. Like, let me look more into it.
Yeah, they are kind of a cult in this community. Costco is. Everybody just loves them.
Yeah, everybody's looking for the next Costco, the next Amazon, or the next Berkshire Hathaway. Those are like the three. And
I've got to get in a piece real quick though, because I had a little pushback after my pitch, because I fumbled a question about the Costco comparison a little bit. I don't want anyone to think that I think Motorpoint deserves a Costco valuation at all. Simply that their model is pretty similar in what they're trying to do in a separate area of retailing, and maybe they should get a portion of that type of quality multiple, and then discount that for the fact they're cyclical, the fact that there's more competition. But it's a kind of a style or a model, at least, in valuing a quality company like that might have a price advantage. But yeah, I don't know who will be listening, but I just want to clarify that I don't think Motorpoint should be valued in line with Costco.
when Costco dropped in price to about like just above $300, did that ever pique your interest? That was a couple months ago.
Yeah, I remember that. So Costco is one that's on my list. I've never owned a share. I've never felt like it's cheap enough, but I know people have been saying that for 20 years.
Mm-hmm.
But I think I know my price is lower than 300, maybe not too far, but I guess I would say I had my eye on it, but I think there were other things I was watching even closer at that time.
I think the big thing for me with Costco is whether they can expand into China or not.
Yeah, and you also are making an interest rate bet as well, I think, just because if you're looking at duration and certainty, I don't know of anything that beats Costco in the market right now. That's probably the gold standard. So if rates do go up and everything adjusts to reflect that, I would think that would kind of affect Costco's multiple more than some other names. Maybe not just because it's such a great company, but I do think there's some kind of rate bet with that stock.
Yeah.
Going back to your investment style, or just investment journey, like who has impacted you the most as an investor other than Buffett or Munger?
Yep, there's Buffett. Spent some time on Graham, but I wouldn't say that impacted me as much as Chuck Akre did at Akre. I believe it's Akre Focus Fund is the fund that he ran. He recently retired, I think, in the last year. But he has a super great track record and has done some really nice talks that are on the internet. You guys have probably seen them, but his investment philosophy, I think, is super simple but super effective. He's got the three-legged stool where can you understand the business? Can you identify the competitive advantage? And then is management doing the right things? And if you've got all that in a reasonable price, then you're pretty much set. And those type of businesses, that philosophy was probably couldn't have been a better philosophy to start with 10 years ago, looking at where we are now. Now it seems like it's a lot harder because once you find those companies, it seems like you're looking at 20, 25, 30 times earnings, no matter what. Whereas 10 years ago, I'm pretty sure if you look back, a lot of that's in the mid-teens multiples on earnings, maybe even low teens on really good companies today. But yeah, Chuck Akre, that's kind of what pushed me towards the quality growth at a reasonable price style. And I wish he would write a book, but his talks are fantastic. And they've got some blogs on their fund website too, I think, by some of the other guys that worked underneath him who are also super talented. That's probably the number one 13F fund portfolio that I look at every quarter to see what new did they buy, because I need to start looking at that right now.
What other names do you look at for 13Fs?
I check Berkshire Hathaway, but that's in the media as soon as there's anything out. I look at Markel. Theirs doesn't really move much at all, though, just because they're an insurance company and they manage very conservatively. I look at Klarman, even though I don't really feel like my style is like his at all, and I've never copied one of his ideas. Who else? That's all I can think of off the top of my head right now. I know that Punch Card Capital, which is Norman Liu, they've got a position in Motorpoint. When I figured that out, I was pretty fired up because I like his style a lot. I've read about his history.
I was just about to say if you knew who Norbert Liu was. He's quite the character. I mean, have you ever read his VIC write-ups?
I have read. Was it the NVR one?
Yeah,
I read the NVR one.
Yeah, he's
really good write-up.
There's like a full, like, what is it, like
30-40 page.
Well, 30-40 pages, but then Greenblatt was the one that put some money into his actual fund to like start him up.
Yeah.
After the NVR write-up, and he goes through at Columbia Business School for like 2.5 hours, like a full lecture of like a couple of the write-ups that Charlie 479 did. Probably one of the better YouTube videos on YouTube right now. But
he tells all the students, this is how you do a write-up right here.
Yeah.
But
when I saw that his fund had a stake in Motorpoint, I was like, okay, maybe I might be onto something here. That definitely kind of gave me a little boost.
Yeah, because I think he only has 5 holdings like he has 5 holdings from the US plus international, and then only 3 from the US. So no, it's he's pretty interesting. We don't really look much at Chuck Akre. Is it Akre? Acre.
It's
I've got a
Acre.
funny story if you're talking about pronouncing his name. I ran into him at a conference in Omaha the first time I ever went to Omaha, and I think I was 20 years old, and ran into him, and I was like starstruck, got the big googly eyes, and I'm like, wow, this guy's like a investing legend, great track record, and I've learned a ton from him. And I went up to him and I told him I really admired his work, and I mispronounced his last name. So I definitely know how to pronounce it now, and it's Acre.
Acre. Okay. Because I've heard it on
That's
a couple
different.
podcasts before and a couple of YouTube videos. Like I haven't watched much on him. I probably should, honestly. Like I'm not really well versed on Chuck Acre, but
Yeah.
but yeah, I've heard on a couple podcasts like some people just butcher his name. I'm like, I know that's not it, but
Yeah.
but no. So
So
have you gone to the Berkshire meetings?
Yep, I went in 18 and 19, and I go a little early, and I go to the Guru Focus Value Investing Conference before that as well. They bring in a ton of speakers for a day and a half and have a dinner on the Thursday night. And it's really good learning opportunity and kind of kicks it off before the Berkshire meeting.
Jake and I are hoping to go next year because it's been virtual the last 2 years we've attended, but so it's a little bit of a trek for us. It's like 28-hour drive one way. So I think we're gonna have to fly.
Yeah.
or sleep in the Walmart parking lot along the way.
Yeah, sleeping in the Walmart parking lots. But
it's only 6 hours for me, so I'm in good shape.
So has your psychology changed since you started investing other people's money? And has it changed your position sizing within your portfolio?
Not a lot. If I had to like find evidence, I would guess subconsciously just making sure I'm taking care of money that other people worked hard to earn and save. It probably has, from a risk management perspective. My position sizing, my initial position sizing, I should say, how much I'm willing to start a position with has definitely dropped a lot as I've gotten to this point of being able to say, okay, I understand my top 5 companies a heck of a lot better than my other lower 15 or anything new. So I'm not going to put much into anything outside of my top 5 or top 10 as an initial position. And just knowing that I trust the people a lot that I run money for. It's a lot of friends, family, and a ton of people just from my hometown. And they trust me, so I'm pretty flexible, have a go anywhere approach. And I just tell them, I'm doing the same thing with your money that I'm doing with my own money. So if I'm eating my own cooking, if it goes wrong, I definitely lost money too. So I'll do my best to manage the risk. I'm going to work hard and we'll see how it goes. So far, it's gone pretty well. But yeah, I do think that I probably have lowered my concentration maybe just a little bit as I just learned more about how the world works and how uncertain everything can be. Because I feel like when you start investing, you think every idea you look at is going to make you money. But you've got to, once you understand probabilities and you start looking at, everything, all the stars might look like they align on this idea, and I could still get smoked. I've had that happen on one thing, and that was enough for me to figure out, okay, I need to have a diverse range of bets, understand which ones have the highest certainty, understand which ones I know them the best relative to other market participants, and then kind of size things up that way is kind of the way I've been working in the last year or two.
But I think that's where a lot of the growth going forward is going to come from. We're just going to take a quick break to talk about Quartr. Quartr is a new way of doing company research. The first mission is to enable access to conference calls, investor presentations, transcripts, and earnings reports as frictionless as possible, straight to your pocket. Their second mission is to create a completely new way for companies to reach their investors and vice versa. They change the way people look at investor relations. Their initial core product is now available for both iOS and Android, but stay tuned for additional features during the coming year. Quartr is 100% free. They include companies from 15 markets today and plan to add more during the coming year. They prioritize requested companies, which you can easily do in the app. They have a lot more in store in the back half of the year, so make sure to follow Quartr on Twitter. Their Twitter handle is at Quartr_app, and Quartr is spelled Quartr. That's Quartr. Now we're going to head back to talking with Bryce.
Interesting. Do you want to discuss a little bit about DB Capital and explain to the audience like what exactly you do?
Yep. So I am an independent investment advisor, pretty much a one-man band, and I'm running super small, subscale, but I've been growing pretty quickly just with word of mouth of people I know. And I really enjoy working with younger people, even though a lot of people will tell you it's hard or impossible to make much money or run a good money management business with younger people. But the story behind that, the reason I wanted to do it independently was, one, I like having flexibility to have kind of the go anywhere, look at anything, invest in anything approach, wherever the value is, which when you're starting out and working at a company, you're probably just going to have to sell funds or sell stuff that, you know, maybe you don't really believe in. So it's not that I didn't want to work with someone or for someone, but I really don't want to sell something I don't believe in, or that I'm not willing to put money in, put my own money behind at least. So I talked to a firm about kind of a financial advisor, investment advisor type position, just entry level. This was right after school. And he kind of told me, you know, they ask you who you know and who you could bring in as a client. And he kind of just said straight to me, you know, we don't work with young people because you can't make money off of young people. And I totally understand that perspective, but I don't really like it, because I think if you form a solid relationship with a young person that has the right mindset and is motivated to really start building their retirement assets, I think it can be a really good, profitable relationship for both parties. So that kind of turned me away from seeking out a financial advisor position at a company. And I knew that I knew enough people, and if I was just patient and operated with transparency and integrity, and if I did a good job, I knew I could make it work eventually. So by the end of this year, I'll probably be able to get up to 3 million of assets, which is absolutely tiny in the industry, but I was about a third of that a year ago. So able to grow it pretty quickly, adding new clients. And then I've got just a ton of young people that I've kind of gotten motivated to where they're all maxing out Roth IRAs every year, or they've got $300 monthly automatic deposits. And these are 19, 20, 21, and 22-year-olds. A lot of them are still in school, just because I just got out of school, and these are the people I know. And I just word of mouth talk to them and say, hey, this is really important. If you get on this under the age of 25 and stick with it, you'll be set up pretty well for retirement. And no one else is working on this right now, so you can really put yourself ahead. That's where I get a lot of fulfillment doing this. I mean, I spend majority of my time researching and trying to find companies, but when I want to interact with people, that's the thing that kind of really fires me up, is when I can get a 21-year-old to open an IRA, even if it's not max contribution. If they can hit half contribution until they're age 25, if you run the numbers, the compound interest tables, it's just a huge difference versus if they wait to start till they're 30 or 35. So that's kind of the thing that lights a fire on me, keeps me going, because I know I can make a big difference for a lot of these younger people. And I think they'll be really solid client relationships long term. Because if you look at the runway, if you do a decent job, you know, these IRAs, I've got probably half of my clients are IRAs, and then I've got some older clients too that have a lot more money that really kind of fills out my asset base. But over the long term, there's a lot of value, I think, in having a really solid young client base that is motivated and willing to put money up and grow their assets.
Yeah, like I mean, I'm 20, Jake's 21. Like we have very similar buddies because we're both from the same town. But if you want to wow a young person, you sit them down for 10, 15 minutes and explain compound interest and then show them what their savings account would look like after, 50 years of compounding, just 20% of their net income over those years, or even 10%. Their faces every time are like, nah, that
Yeah.
can't happen. That can't
Nope.
happen. It's like, no, it's happened for hundreds of years, right? So
Nobody ever believes it. It's crazy.
no,
It's hard to get them started in it though. Like it's hard to get them to commit to actually, foregoing spending money right now for later. It is really hard though.
And there's always the fact that who even knows if you're going to be around when you're 65 to spend the money, which totally real risk. And that's what makes it hard. But as long as you can still find a way to enjoy yourself in the present without that money and you don't need it for your bills, I love socking it away. Every time I make a deposit to my account, that's one of my favorite feelings.
do you find it hard or difficult to be investing when you have almost monthly income coming in from your clients?
Yeah, that's actually a great point, and it has been a real challenge the past probably year, where I've had a hard time finding good ideas that fit my criteria. I've only bought, I think I've only made two actions really in the past 12 months. And one of them was just adding to Motorpoint when it got cheap in the spring, because I already had a position from that. I've been in that for about 2 years. So every month money's coming in these IRAs, and just from new clients that say they transfer in a bunch of cash or an account from somewhere else, and they say, just start over with this. We'll put it to cash and you put it into your stocks. But this is money that people have worked hard to earn it and save it. Like I mentioned before, I don't want to just blindly invest it in the best opportunity I see at the moment if I'm not positive that it offers a margin of safety and a chance for a reasonable return, which is kind of my number one approach. I like to get the margin of safety through price by getting a good discount to what you think it's worth, which right now results in me really not doing much at all. It's just been hard to find anything good. So I've got a lot more cash sitting around than I want.
So once a client's money comes in to you, it'll go into like how the percentage is for each position, right? It'll go right into that, and it'll be like that for their portfolio as well, correct?
I can set it up like that, but I actually don't. Maybe over time I will, but as of now, it comes in, I put it into the best opportunities I see available, or if it can't all be deployed, it'll just sit in cash until I do find something.
Okay.
So in the past year, that has looked like an awful strategy because the market only goes up, and I haven't been able to invest 100% of a new deposit that comes in and feel like I'm, one, adequately diversified, two, getting good value, and three, making sure there's not a substantial risk to permanent loss on this new money. So a lot of the new money that comes in just sits in cash, and I'm really just kind of waiting around until I find the opportunity. I was really glad Motorpoint got cheap in the spring because I was able to put a decent amount into that.
Interesting. Do you find your psychology has changed any bit just from privately invest or personal investments than to bring on clients?
Yeah, definitely. If I was all on my own, I would probably try my hand out in a lot more different things that I know are a little more risky and that I know I'm probably not as qualified or not as skilled with, just to see what works. And I'm okay a little bit with kind of the gambler's attitude with my own money, but definitely not with other people's money. So managing their money, it's strictly stick with my criteria, don't venture outside into something new, and just be patient and wait for the right opportunities. But when I started, it wasn't necessarily like that. I wasn't patient, tried all kinds of different stuff, and I'd throw money into any idea, even if I found it a day before and thought it was a decent idea. But I don't think that's a very good way to invest.
What
There you go, Jake.
What's one thing that you know now that you wish you knew at the start when you first started investing?
Probably going back to, I've mentioned it a couple times, but just understanding that not every idea you see, one, is a good idea, and two, is gonna work out well. Because it goes back to the process over outcome. You can have a great process, make the right decisions, and just the nature of probabilities, it can still not go your way. So really taking that concept and incorporating it into the strategy and the way you think about portfolio construction, I wish I would have had a better grasp on that early on, because like I said before, if it looked like a half decent idea and I spent a little time on it, you have the time commitment bias with that. I know that got me a lot when I was starting. I would just throw money into it and expect it to work really well. Never got burned terribly bad and learned a ton of stuff doing it that way. I think there's something to be said about frequency of ideas, putting a little money in it, either making money and getting positive reinforcement, or losing some money and trying to learn something from it. I think there was value from that. It maybe sped up my learning process, but I was just way too active when I was getting started. Mostly with my money, I slowed down pretty quickly once I had other people's money. But yeah, I am, even in just 2 or 3 years, I am so much more inactive now than I was then.
Interesting. Where are you generating a lot of your ideas from currently?
I really like the copycat approach, looking at some of the smartest people, what companies they're in. I never just blindly buy something because they bought it, but that's where I start my research. I look at every company that Chuck Ockray's got in the fund, and I say, is this something maybe I can understand? Can I try to figure out what the competitive advantage is here? What's the growth runway? And then I try to value it on my own. And then I go ahead and find my appropriate discounts where I want to buy it at from there. But yeah, in terms of finding stuff, a lot of copycat in the 13Fs, and then Value Investors Club on Vic, find some ideas on there. And then let's see if I found anything else. Corner of Berkshire and Fairfax is another good board. Other than that, though, I think there's just I think there's a ton of value with the copycat approach, as long as you do your own work. But as a place to start, I don't know how you could find a better set of companies.
No, I mean, me and Jake are very big Monish Pabrai fanatics almost. That's kind of the first guy that we started looking into. I mean, obviously it was Buffett, Munger, and then we came across Monish's videos. And so he calls the copycat approach cloning. And we found that very helpful. Me and Jake are almost on Dataroma or Ticker Terminal almost every day, I'd say, just checking to make sure if anybody else comes in, because there's always some new fund that comes in every now and then. But now when 13F season comes around, it's pretty exciting.
It's the best screener out there, in my opinion. It's the best
screener
out there.
Yeah, I used to do screens. I never really do them anymore. I think you spend a ton of time doing that, and your odds of finding, at least with my approach, the odds of me finding a company that will have me better off than the top 5 or 10 I already have spent a ton of time on, it's so slim. I don't even really spend any time there.
Yeah, because if it's an obvious screen, then most people will jump on that and then it'll be gone, right?
Right. Yep.
Well, even you can't really screen quality either. With a quality business, Like,
there's no qualitative aspects on a screen. And
no.
with Motorpoint as an example, I think that is a qualitative approach, because if you want to comp it to a used car dealer, a cyclical used car dealer, then they're probably really expensive right now. But if you want to comp it to a highly scaled retailer that's trying to save a lot of money for customers at 4% market share, super high net promoter score, super high repeat customers, really good management team, what I think are defendable competitive advantages, then maybe it should trade higher than a traditional dealer multiple. So that's just something that you have to read and really dig deep, uncover all this information to come to those conclusions and connect the dots.
I mean, it's similar to like Apple in 2016. A lot of people were looking at it as hardware business. And then once people started understanding that it's a consumer staple, then it trades, 4x or 5x since then.
Yeah.
So it's almost all how the market looks at it now. So if the market looks at Motorpoint as just valuing it based on other car business, like used car businesses, then if it was to change its whole, I guess, business idea, like the ideas that people have on it or persona, then the multiple could change just almost overnight.
Yeah.
Basically what you're saying is, sorry, you go there.
Well, I was just going to say, yeah, like I said, if you comp it to traditional dealers, it looks pretty expensive. But I'd ask anybody to find a used car dealer that is running those type of volumes out of their sites, has 100% return on capital, operating on 3% retail vehicle gross margins. So once you can find another dealer doing that, then maybe it doesn't deserve a higher multiple. But yeah, I think there's a lot more going on there than just a cyclical used car dealer.
For sure. That's even just through the write-up. And I've done a little bit of research on it beforehand, just since it was on Norbert Lou's 13Fs. But no, like, it is a high quality business that is selling fair price. Like, it's one of those things that's really interesting. When it's like, again, anything that is compared to Costco in any way, even it can get a portion of the multiple that Costco deserves, then it seems like a pretty interesting idea, in my opinion. Going back to your DB Capital advisory, do you think you'll always be a one-man band, or do you think you'll kind of grow out and start getting into, having a bigger business?
More employees and stuff.
Yeah. I like the independence just for the investment flexibility and the just independent thought framework. No one can really tell me what I can or can't do with the investments, which obviously with inexperience and youth, I understand that presents risk too. So I try to take that in mind, that I try to understand there's a lot of things that I don't know, and not do anything crazy or stupid. But I don't really want to work by myself long term. I don't know what type of form that it would change in, but I like collaboration on the research side, maybe not on the portfolio management side, though. I would like complete independence on the portfolio management side, but I would love collaboration research wise, or to have partners or people working with me that are doing the type of digging I'm doing and bouncing ideas off each other. And then we'll just value the business and decide how much to buy and when to buy, and do that separately, because that's where I don't think group decisions work. But I'm too small to even think about hiring anyone right now. I'm in a year or two, I think I'll get to the point where just me, I'm in a pretty good spot, and then go from there. But I would really like to get to the point, if I had the scale, to hire people to help with the research. or just the client, managing clients and relationships and raising capital.
Yeah, like I found we talked about it with a few guests on the podcast, but like FinTwit has really helped us a lot. Just talking to other people that are uh, eons ahead of us, and they've gone through, the years of experience, and then they're able to just explain that to us and kind of just go through lessons that they've learned within an hour or 2 hour conversation. I find that's helped us a lot, just generating ideas. And I find just having, yeah, like me and Jake eventually I think might start something partnership wise. I'm not sure if we'll have separate accounts or separately managed or not, or if it'll be joint and we'll be within partnership that way. Um, but I found a lot of my learnings. Hey, Jake would have say like collaborations. If you can have one person that learns one thing, one person learns the other, and then come back on it and discuss it within an hour, it helps out both people like a lot.
Or if you can have someone that plays the bear case too, right? So you can kind of try to destroy their bull case, and that kind of helps you so you don't get too optimistic on things.
Honestly, my little brother is kind of my silent employee. I don't pay him, but he's my number one guy to bounce ideas off of. He doesn't spend as much time in this stuff as I do, but he knows the basics. He's read the books, and he can have a good conversation about an investment thesis or kind of what's going on. So that's my number one go-to to say, hey, this is what I just found. I think this is kind of interesting, might be a little unique here. I'll send it to him and he can kind of bounce ideas that way. Maybe he'll be the first person I hire down the road, who knows? But he's the one that kind of got me into investing after watching The Wolf of Wall Street, said, we should probably look into this stuff. Maybe it'll be interesting and we can make some money, the stock market. So yeah, I agree. If you have someone you can bounce ideas off, collaborate, someone to kind of check your ideas and say, that might not be a great idea for XYZ reasons. Yeah, I think that's super helpful.
Interesting. Like, so you guys both just watched Wolf of Wall Street and then both kind of got hooked onto investing? Is that kind of how it went? Or did you hook him onto investing?
It was his idea to start learning about it and reading books to figure out if it's something we thought we could maybe make some money at. I was the one that investing kind of grabbed me and pulled me in, and I never really stopped going down the rabbit hole, to the point where I know at times I've annoyed the heck out of him by just sending him stuff that I'm learning or finding. I've kind of pulled back a little as I've gone so far down the road from him, to where I don't blow him up, but I would just send him super long text, books worth of a text about, hey, I just learned this, or I read this article about dividend reinvestment and what it can do for you over the long term. Just those exciting things that you're learning when you're getting started, figuring out how all this works. It all just kind of grabbed me, and I threw everything I learned back at him, since he kind of pulled me into it. I tried to continue to teach him, and then he can do even better checking me on my ideas.
Yeah, I've found myself to annoy a couple of people. Like, I got a bunch of buddies that are in trades, and they're not really in the finance world. Like, they'll be like, yeah, okay, like eventually when I get a decent job, I'll start helping you out with right, with management or whatever. But yeah, like I'll tell them like my thesis on Heritage Growth Properties and how I think that their redevelopment plan is going to be amazing, and I'll go into an hour-long conversation. They're like, man, I was not listening the whole time.
Yeah. It seems like once you find something and you like it, you can just, if you're really into this stuff, you can just talk about it forever, and really no one else wants to hear you talk about it.
No, exactly. Like even if somebody says like, okay, I gotta listen to it for a little bit, then like you go 20 minutes into it, then they're like, all right, I'm bored of this idea.
Yeah.
But then if you get a good partner, then sometimes they'll be like, okay, this is interesting, and let's dig deeper and figure it out.
Right.
But No, man, it's been great having you on today. We'd like to do it again, obviously, within a couple of months or so. Maybe if you have a new idea, then we can talk about that. But where can the listeners come and find you?
My Twitter is at bdools, DOOLS 2. I don't tweet a ton, but I've got links to my website on there, which also links to my blog, which has some of the research and write-ups on there as well. I'm really not super promotional. I just put a website together earlier this spring. I like to spend 95% of my time researching. I don't do much marketing at all. I would like to let the results speak for themselves, and being so inexperienced, I am not in a position to go and say, hey, I'm going to make you this money, XYZ% return in this amount of time. I'm trying to stay as far away from that as I can, just be transparent with people and tell them I'm going to work hard, do my best, and I'm managing my own money the exact same way that I manage yours. So if you trust me and you're patient, maybe after a few years, it might turn out decent. So that's kind of my approach. Other than that, I don't tell people much, and I don't do much marketing. But yeah, you can find all the links on my Twitter page. I really appreciate you guys for having me on. I don't really feel like I have earned a position to speak much about strategy or investing. I just really enjoy it, trying to learn more, build conviction and good ideas, just see where it ends up. I just really love doing this stuff. But thanks a lot for having me on.
Yeah, thanks again, man. It's been a pleasure, and we'll put all the links and stuff of that to your website as well as your Twitter down below for anybody that's interested. But yeah, thanks again for coming on, and it's been great, man.
Yeah, awesome. Well, I appreciate it.
Awesome. Well,
Thank you, Bryce.
thank you for listening to this episode of Money Under the Mattress. If you have any questions about this episode, you can email us at moneyunderthemattress.podcast@gmail.com. Everything discussed in this podcast is our opinion and should not be used as investment advice. This podcast is for your entertainment and education purposes only, and we hope that you enjoyed it.